Good morning. These are the things that matter most on Wall Street today. The AI trade faces a profit test. Earnings are separating real demand from expensive mistakes. And the Fed still has to judge whether lower oil is enough to calm inflation risk. The central question for private investors is simple. Is this still a broad risk-on market, or is Wall Street starting to demand proof from every crowded story? Start with AI and big tech. CNBC reported that Amazon, Meta, and Microsoft face skeptical investors this week after Alphabet's report sparked a sell-off. The issue is not that AI demand disappeared. The issue is that investors now want to see whether the largest platforms can turn massive AI capital spending into cash flow, cloud growth, and pricing power. That puts Meta, Microsoft, Amazon, Alphabet, and NVIDIA at the center of the morning. The cleaner side is platforms that can show accelerating cloud revenue, disciplined capital spending, and clear AI products customers actually pay for. Pressure sits with companies where spending rises faster than free cash flow, or where the AI story depends on circular financing and cheap credit. For private investors, the takeaway is proof over narrative. AI can still be the most important long-term theme in the market, but today's tape may reward evidence and punish promises. Second, earnings quality is now the market's most useful filter. CNBC reported that Boeing posted a wider loss than expected as Air Force One costs weighed on results. But MarketWatch noted the stock rallied as revenue and backlog looked better than feared. Coca-Cola topped earnings estimates and raised its full-year outlook as drink demand climbed. UPS beat expectations and raised guidance. PayPal delivered an earnings beat, but investors were still focused on the next strategic step. That mix matters because it shows a market that is not simply buying every earnings headline. Potential winners are companies with demand, backlog, operating leverage, and credible guidance. Pressure sits with names where a headline beat hides margin risk, restructuring costs, deal uncertainty, or weak cash conversion. For private investors, the practical takeaway is this. In earnings season, the first number is often not the story. The market is asking whether the result changes confidence for the next 2 quarters. Third, oil and rates are still the macro gatekeeper. MarketWatch reported that oil prices declined further after President Trump claimed deep talks were underway with Iran. Lower crude is helpful because it can ease fuel costs, inflation pressure, and consumer margin stress. But MarketWatch also flagged a quieter climate and inflation risk. A strong El Niño could keep pressure on food, energy-adjacent costs, and the rate cut debate. For Wall Street, that means lower oil helps, but it does not automatically unlock a full Fed relief trade. Beneficiaries can include airlines, transports, selected consumer names, and companies with fuel sensitivity. Pressure can return to energy producers, refiners if margins shift, and long-duration growth if the Fed still sounds cautious. For private investors, the takeaway is to separate one helpful price move from a complete policy all-clear. The useful question is whether lower oil actually changes inflation expectations and Treasury yields, not whether the crude chart is red for one morning. The underappreciated story is market structure. CNBC reported that CME launched single-stock futures that let investors trade names such as SpaceX and Micron for 23 hours a day. On its own, that sounds technical. But for private investors, it matters because more trading hours can make hot names feel more accessible while also spreading price discovery, leverage, and emotion into thinner sessions. Potential winners are exchanges, brokers, and sophisticated liquidity providers that benefit from more activity. Pressure sits with private investors who treat extended trading as an edge without understanding liquidity, spreads, overnight headlines, and product mechanics. For private investors, the takeaway is simple. More access is not the same as more edge. A product can be useful for price discovery and still be dangerous if the investor uses it as a shortcut. Here is the stock-led watch list. First, Meta, Microsoft, and Amazon. The question is whether AI spending reads as productive investment or a cash flow drag. Second, NVIDIA, Micron, and ASML. Watch whether the chip chain stabilizes after the sell-off, or whether China tool and credit worries keep pressure on the picks and shovels trade. Third, Boeing, Coca-Cola, and UPS. This is the earnings quality basket, backlog and guidance versus cost problems and margin doubt. Fourth, Exxon, Chevron, and United Airlines. That group tests whether lower oil is real relief or just a one-day macro headline. Fifth, CME, Robinhood, and Interactive Brokers. That is the market structure basket around longer trading hours and more retail access. Market bias, selective, earnings-led, and proof-driven. The market can recover from a chip sell-off if big tech explains AI returns clearly and earnings quality stays firm. The mistake to avoid is treating every relief signal as the same trade. Lower oil, strong revenue, AI spending, and extended trading hours all mean different things. Today's useful filter is cash flow, guidance quality, inflation confirmation, and whether crowded stocks can hold support without easy narratives. That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.